Welcome to the Accounting Superstar channel, the place to learn accounting. I've been teaching accounting for about 30 years and I've been a CPA for about that long, and I've got a lot of fantastic ways to explain things. So today we're going to learn about something quite important. It's the sales returns and allowances, and we're going to focus on credit sales. It's something that's really pretty easy. It's straightforward, and I'll explain it to you. So the subject of our lesson today is Fred's snowblower service. Fred owns a snowblower service up in Breckenridge, Colorado, about 2 hours from where I'm at here. Fred's busy season is in the late fall. So that's when he sells the most snowblowers, when the snow starts falling and the skiers start returning to Breckenridge. The number of snowblowers sold during the current year is 200 snowblowers, which is pretty typical for Fred. The retail sales price for each snowblower sold is $1,500. Fred's wholesale cost per snowblower is $800 and turns around and sells them for $1,500. And so far this year, Fred has had 3 snowblowers returned. Not too bad, but Fred knows that a couple more will probably be returned this year. He doesn't know who will return them, when they'll be returned, but he just has this strong feeling that probably 2 more snowblowers will be returned. And this is based on past experience, and it's usually not a big problem for Fred. Fred takes these used snowblowers that are returned and sells them on eBay and Craigslist, so it all works out okay for him. Let's do the journal entries. The journal entries are very, very straightforward. They're really quite easy. And these journal entries are summarized journal entries. They're normally Fred would record each and every sale into his accounting records, but we're just trying to see the big picture here. So we'll do this in a summarized format. So Fred is going to record these sales and accounts receivable. That is selling 200 snowblowers at $1,500 each. If you do the math, that would bring you to $300,000. So sales of $300,000. We're crediting sales because that's revenue. Revenue is credited. Cost of goods sold. This is the cost of snowblowers for Fred. So Fred sold 200 snowblowers. The snowblowers cost Fred $800 each. So here we go. 200 snowblowers at $800 each is $160,000. Fred is debiting cost of goods sold, which is an expense account, and Fred is crediting inventory, reducing his inventory by $160,000. Sales returns and allowances. Now these are the snowblowers that were actually returned, and there were 3 snowblowers actually returned, and these snowblowers were sold for $1,500 each. So Fred needs to record this return, $4,500, and he's crediting accounts receivable because he knows who these customers are and that these customers will not be paying him. So coming down to returned inventory, Fred is making note in his accounting records that he's got more inventory. Now this is not brand new inventory that he can sell as brand new snowblowers, but these are used snowblowers that customers have returned, and Fred will sell them on eBay and Craigslist. Now Fred paid $800 each for these snowblowers, so 3 times 800 is $2,400. And Fred is going to credit cost of goods sold. So he's going to reduce his expense by $2,400. So those are the entries that Fred typically makes during the year. Now we're coming to the end of the year, the very end of the year before Fred creates his financial statements. And Fred is going to do end of year adjusting entries. And these are only done right before you do your financials. So here we need to consider these 2 snowblowers that have not yet been returned, that Fred doesn't know who they'll be, who the customers will be, and he doesn't know when they'll be returned. But he just has this strong feeling that 2 will be returned. And if Fred did not do these adjusting entries at the end of the year, Fred would overstate sales and overstate his profitability. So Fred doesn't want to do that. He wants to have a good set of accounting records. So we're going to debit sales, returns, and allowances for these 2 snowblowers that have not been returned but are expected to be returned. And Fred sold these snowblowers at $1,500 each. So 2 times $1,500 is $3,000. And we'll credit the allowance for sales, returns, allowances for the exact same amount. So this allowance for sales, returns, and allowances, this is going to go against the accounts receivable. It's a contra receivable account. And we'll see how it shows up on the balance sheet. Estimated inventory returns. These are the 2 snowblowers that have yet to be returned, and Fred's cost for those snowblowers. So 2 times $800 is $1,600, and Fred is going to reduce his cost of goods sold by these 2 snowblowers that have yet to be returned. And again, Fred doesn't know who they are, who the customers are. He doesn't know when they'll be returned, but he just has a strong feeling they will be returned. And Fred does not want to overstate his financial position. Coming down to the income statement and balance sheet. So let's see what the sales were. Sales were $300,000. Less sales, returns, and allowances. So sales, returns, allowances. Fred had 3 snowblowers returned at $4,500. And Fred expects another 2 snowblowers to be returned for $3,000. So $4,500 plus $3,000 is $7,500. And I'm going to subtract this. I've got it as a negative number because this is a contra sales account. It goes against sales. So net sales is simply going to be the difference between these 2 numbers. So the net sales, $292,500 minus cost of goods sold. Cost of goods sold once again is an expense. So cost of goods sold, $160,000. But I'm going to reduce that cost of goods sold by $2,400. That's the cost of those 3 snowblowers that were returned. And I'm going to reduce cost of goods sold by the cost of the 2 snowblowers yet to be returned. So in other words, $160,000 minus $2,400 minus $1,600 is $156,000. Gross profit is simply going to be net sales minus cost of goods sold will give us gross profit, $136,500. Moving over to the balance sheet. Now accounts receivable is going to be the $300,000, the sales for the year, minus the 3 snowblowers that were returned because the customers are not going to pay for these. They returned those snowblowers. So that's $295,500. That $300,000 in accounts receivable minus the returned snowblowers of $4,500. So there you are. Less allowance for sales, returns, and allowances. Now that is the 2 snowblowers that Fred expects that will be returned. Less allowance for sales, returns, and allowances. And it sounds like I'm repeating myself when I say allowances, but that's how the account ought to be listed. Allowance for sales, returns, and allowances. This represents the 2 snowblowers that are expected to be returned. Fred does not know who they are or when they'll be returned, but he just knows that they probably will be returned. And I have it listed as a negative $3,000 because that is a contra accounts receivable account. It helps value accounts receivable. So $295,500 minus $3,000 is $292,500. And lastly, we have the returned inventory. So the returned inventory, we've got $2,400 here, and Fred expects another $1,600 to be returned. So $2,400 plus $1,600 gives us a grand total of 4,000. So we're just simply combining those two numbers together. So ladies and gentlemen, what did we learn today? We learned that it's important to keep track of these sales returns allowances. These sales returns allowances, I like to think of it as an indicator of how unhappy some of my customers are. So here we have on our income statement less sales returns allowances of minus 7,500. That represents customers that did not like their snowblowers for whatever reason and returned them. So we want to keep that number as small as possible. Also, we learned today too that when customers return inventory, it might be a good idea to set up a separate inventory account called returned inventory, because we can't sell that inventory that was returned at regular retail prices, but we'll probably have to sell them at a reduced price, maybe on Craigslist or eBay. So ladies and gentlemen, I hope you enjoyed this lesson. I hope it helped you out. And if you like this, hit that subscribe button and smash the like button. And I'll see you next time. Thanks, and over and out.